o'clock, and I think we'll go ahead and get started. Good morning. I'm Christy Cole, the Director of Philanthropy at the Arlington Community Foundation. Welcome. We are so pleased to have you with us this morning for this webinar on the relationship between financial organizing and financial confidence. Now, as if more folks are continuing to enter, please go ahead and introduce yourself in the chat. The chat will remain open for a couple more minutes. And then as we progress through the panel discussion, we invite you to put your questions in the Q&A. And we will address some of them as we can as we move through the panel discussion, but we have held time at the end to have a thorough Q&A session. So you might be wondering, why is the Arlington Community Foundation hosting a webinar on financial organizing? You may know us because of our scholarship program that awards over $600,000 to Arlington students each year. Or perhaps you have heard of our prompt response funding in times of crisis like the COVID-19 pandemic. Or maybe you even know about our shared prosperity work, where we have worked with our local government, the business community, and our nonprofits in Arlington to address the challenges of economic mobility, things like affordable housing and affordable childcare. As a community foundation, we play many roles, but our most important one is to harness the power of philanthropy to improve the quality of life in Arlington and beyond. We are here to help people who care about the community achieve the long-term positive impact that they'd like to make through their charitable giving. And we know that decisions about charitable giving are not made in a vacuum. People who are confident in their day-to-day financial management and in their plans for the future, for taking care of their families and the people they care about, well, we know that they are in a better position to maximize their charitable impact. Good decisions about charitable giving are always made in the context of financial and estate planning. And at ACF, we partner with financial planners, estate planning lawyers, accountants, and other advisors to share our community knowledge and to serve as a charitable planning resource for advisors and their clients. We hope you leave here today with some tangible strategies for managing your financial affairs. And in doing that, we hope you're in a better position to contemplate the charitable impact you might like to make. I am so excited to introduce you to our panel of experts today. All three are very active in our community, serving their clients and in various volunteer roles with nonprofits, churches, schools. We're just so pleased to have them here today to share their expertise. I'd like to introduce Christine Dolan, Daily Money Manager with C. Dolan and Associates, Ryan Brown, Estate Planning Attorney, Arlington Law Group, and Todd Eyrig, Financial Advisor with Invest with a Plan. We'll start our program today by taking some time to talk about the different types of knowledge and expertise that are needed to make good planning decisions and good daily money management decisions. It's easy to think of ourselves as a wheel and the various advisors as spokes, but I think everyone on this panel today, and I know this from our conversations and planning it, would say that a coordinated team approach with all of the players at the planning table working together is the best way to serve the client. So I'd like to start by asking each of our panelists to talk a little bit about themselves and their role on the planning table. Todd, let's start with you.
Great, thanks, Christy, and appreciate all the attendees being with us today. As Christy said, this is a continuum and everyone in this group has a role to play. My specific role as a financial planner and an investment advisor is to help people invest with a plan. As Christy said, we make these decisions in the context of an overall plan and strategy. My specific role is to help people first articulate their goals. What are they trying to achieve? What is the purpose for the money that they're saving? And ultimately translate that into investment strategies that works towards those goals. There are enormous levels of coordination that should happen, sometimes don't, but often should, with other professionals within this cycle. When we're building investment strategies, we want to make sure that those are sensitive to the tax situation that the specific client is in. We want to make sure that the registration and the titling of the accounts is consistent with their estate plan and how that needs to happen. and that the daily tasks that are happening in cash flow is coordinated with daily money management that they're going through and supporting, and making sure that the regular tasks of maintaining accounts and daily, monthly, quarterly actions are taking place. So just in that quick explanation, you can see the coordination points starting to happen between these professionals.
Absolutely. Ryan, tell us about your role at the planning table.
Sure. Thank you again for having me today, Christine. It's great to see some familiar names and people here joining us to attend. So thank you all for spending the time this morning. As an estate planning attorney, I'm helping people both with their managing of assets during their lifetime, providing for what happens if they're incapacitated, how do their family members or friends take care of them, and how do they continue their legacy, both for their family and their community after their death. And having the right legal documents in place can both simplify the administrative work for the family, saving time, saving hassle, and also reduce taxes and reduce just the overall complexity. So it's really important to have all the correct legal documents in place, and we'll talk about the details of that in a few more minutes. And then to have those coordinate with the other people on the planning team. You can't do the estate planning without the tax planning. You can't do the estate planning without understanding the client's assets and working with their financial planner to get the beneficiary designations and title set up correctly. If the client's doing the charitable planning with the community foundation, we need to tie all that together and again, do it in a tax efficient manner. So you really have to have a good communication between all these different professionals to come up with the best outcome. The other big advantage of having this whole team is the team is there to carry on, either to help your surviving spouse or your children or the next people that'll be dealing with your affairs, because at some point you're not going to be able to do it yourself. And if you have this team of professionals in place, it makes it much easier for the next individual you designate to be in charge of your financial plan to carry out your wishes, knowing that they have this support structure in place.
Great. Well, Christine, why don't you tell us a bit about your role at this planning table? And I'm going to give you an additional topic to cover, and that is tell us about your role and then also the roles of some of the other professionals at this table who are not represented on the panel today.
Absolutely. Thank you, everybody, for joining today. I'm Christine Dolan, Daily Money Manager, and work with Ryan and Todd and financial planners and estate planning attorneys. Really important because as a Daily Money Manager, I help with the bill payment, the management, the daily, the monthly, annual budgeting and expense tracking, document and tax organization, getting everything up to that accountant who's not represented here, getting all the paperwork together and sent to the accountant, making sure that estimated taxes are paid if you pay estimated taxes on a quarterly basis, and also the insurance agent. Do you have your policies? Are they up to date? Do they need to be reviewed? Do you have a long-term care policy? What is stated on that? What are the parameters on that? Do we need to have a conversation with your financial planner to see about adjusting some money there? Does it need to be transferred because Social Security and pension may not be enough now, or maybe your business needs a little boost after COVID and we need to have a conversation there? Is all of this represented in your estate plan as well? You know, do you have artwork? Has it been appraised? Is that part of your plan going forward? How do you represent that? Where do you want it to go? Do you contribute just randomly? Do you have a donor advised fund? All these things come into play and they trickle down to the daily business of just, believe it or not, paying your bills and managing and staying financially on top of everything you have going on daily and monthly and annually. So thank you for bringing us all together.
Well, Ryan, you know, we've talked about the planning table and the experts around that table. Ryan, why don't you tell us a little bit about what's on the table? What are the primary things that this team is working together to do?
Yeah, and this is the first step of either a financial planning project or an estate planning project, is we need to see what assets and income the client has at their disposal. And of course, the first question is, how do I make sure I have enough to be comfortable in retirement? And Todd will speak to that here in a minute. And then the follow-up question is, if there is something left at my death, where does that go? And how can I, again, do that in a tax efficient manner? And so a lot of the times when I'm working with clients who have charitable goals, we're trying to figure out which assets to use for their charitable giving versus the assets to leave to friends or family members. And doing this intentionally can make a huge difference, both in terms of the tax savings, and then of course the ultimate amount of money that you can leave both to the charities and to your friends and family. And so a lot of clients around here, having worked in the community for many years, have accumulated significant taxable retirement accounts, such as a 401k or thrift savings plan, or a 403b when working at a nonprofit, or maybe they've set up their own IRA or rolled it into an IRA. Those accounts have an income tax liability built in. Unless it's a Roth account, the traditional accounts all have an income tax liability built in. And those can be given as part of their charitable giving at death with no tax. So if you were to come to me and say, Ryan, I want to give 10% of my estate to charity at my death, then I would say, well, let's do 20% of the retirement account assets and then give 100% of the other assets to your friends and family members, which may be able to pass tax-free at your death, depending upon where you are versus the estate tax limits. So setting that up appropriately can make a big difference, as opposed to just dividing up every asset pro rata. And that's where having both the legal documents in place, working with the financial planner, and then tying together the beneficiary designations and so forth can make a big difference. We'll talk a little bit more about donor advised funds later, but you can do that charitable giving in many different ways. You can give it to specific charities. You can give it to the donor advised fund at the community foundation, in which case they can continue to carry out your charitable giving for you over time. You can put a scholarship fund at the community foundation or at your alma mater. There's lots of ways to do that, but we first have to be careful about which assets we're using to fund that, to do that as efficiently as possible.
Absolutely. So, we've talked about who's on the planning team and sort of this overall role in overseeing the management of assets now and for the future. I'd like to shift the conversation to some of the big questions that we all wrestle with, and that are on people's minds as they're trying to get their financial house in order. I know I personally, over the years, often worry about whether I have enough. And I think a lot of people have that concern. And Todd, I was hoping you could talk to us about, how do you know you have enough? How much should you spend and save each year, and to know that you're not going to outlive your assets? Oh, Todd, you're on mute.
Forgot that step. Yeah, that is the $64,000 question, isn't it? How do we know if we've got enough, and are we saving enough? And that is ultimately the goal of building a plan. So there are plenty of online calculators and things that will try to answer this question in a simple way, but to truly answer it in a robust way, you need a full planning exercise. And to answer the question, we start with the goal in mind. We start at the end and work backwards. And so we have to understand what you want your retirement to look like. What does that mean? What goals do we have? What kind of paycheck do I need every month in order to satisfy the lifestyle that I want in retirement? We then flip back to the beginning where Ryan was talking about taking that inventory of assets. We got to know what we're working from. So we inventory the assets, and one of the harder questions I ask my clients at this stage is, show me your budget. And I will tell you that 99% of the clients that I ask that question of, blank stare. They don't have a budget unless they're working with a daily money manager. 100% of folks that are working with a daily money manager have a budget, which is a great service. So we need to understand your cash flow, what's coming in, what's going out, how's that money being deployed, going through mortgage obligations, all of these types of things to understand what are truly the obligations that you have from a cash flow perspective and what assets do you have to meet them. We do some fancy math in a black box and come up with some answers that says, if we save this much and if the market does this, then we can give you a probability of success of getting to your goals. But the point is that this is not a simple one-time answer. Planning is a process because our life changes, markets move, time moves on, our situations change, documents need to be updated, beneficiaries need to be changed from a planning perspective, but cash flow might change, our assets might change. All of these variables that we're factoring into this plan can change. One of the key services that a financial advisor brings to this part of the conversation is a discussion about trade-offs. It is rare that a client comes to the table and has all the assets and all the cash flow that they need to satisfy every goal that they can imagine throughout their lifetime. And so helping clients understand where are the strategic trade-offs and where are the preferred trade-offs. There are some strategic trade-offs about structural things. Should I save for my kids' education or my own retirement first? There's a relatively straightforward answer from that from a planner's perspective, but it often doesn't square with what parents would actually feel like they should do. And the answer is you put your own mask on before you assist your kid on the plane. You do the same with your financial plan. But it's those types of trade-offs where a third perspective, a third party can really help bring questions to bear that give you pause, give you a chance to think about option A or option B. What are the pros and the cons, the tax trade-offs, the estate planning trade-offs? Ryan started to talk a little bit about what assets do we leave behind if we have stuff that we leave behind. And that's a huge trade-off because it puts at head-to-head, at loggerheads, what I'm paying today for my own tax situation versus setting my kid up in their estate tax situation and what I'm leaving behind. And that often creates trade-offs. Is my priority me during my lifetime or my kid when I pass away? So start with the end in mind, inventory of assets, understand cash flow and the goal that we're trying to hit from a lifestyle perspective, and then try to balance the trade-offs between when we can't get them all done at 100%.
And Todd, when you are working with clients who are contemplating, their own retirement, providing for their children now and in the future, and also considering a charitable component to their plan, what do you typically recommend to them, for how to think about that?
Yeah, so there's a general framework. Sometimes get into a conversation with clients when we do know we can decide and find out mathematically that they have assets beyond those that they need during their lifetime. We use a construct or a framework that I call foundational versus generational money. Foundational money is that stuff that we're likely to need during our lifetimes. Generational money is money beyond that. And really break this into two steps. As part of the budget process, those folks who are charitably inclined, I really encourage them to include that charitable giving as part of their baseline budget. Make sure that it fits within the cash flow that they have coming in. I have a give with a plan strategy that is published out on my website and throughout. I send it out through social media near the end of the year when people tend to do their charitable giving. But it talks about setting up a budget and setting up goals and strategies so that you can be very intentional with your charitable giving. I hate to say it, but most people do this randomly and very close to the end of the year, which smacks of not doing it with a plan. So
Todd,
I really prefer people give with a plan.
I love when when I see your social media posts and one comes up in March or July about giving with a plan, because that it really helps people to be more thoughtful.
Yeah, and there's a practical nature of this too that I'd like to highlight is, if you have a budget for your giving budget, it gives you permission to say no. And so if you allocate a bucket for other, and when that bucket is exhausted from people who have asked you at work to join their walk, or the random, people that show up at your door, no, I've exhausted my giving for the year, but I'll certainly consider it for next year. So it gives you a way to really be intentional and make sure that the causes that are most important and passionate to you and that you're most passionate about are the ones that you're supporting most effectively.
Absolutely. So, developing a plan, having a budget, these are really foundational to developing the confidence that you have enough for yourself and to accomplish all of your goals. But many of us are really concerned about our families and the people we care about. And Ryan, I'm hoping you can tell us about what we can do to ensure that our families can manage our affairs when we're no longer able to do so.
Yeah, thanks, Christy. And I love it when people go talk to their financial planner and they get an answer to that question of, what can I afford? I've got so many clients that have done very well for themselves in this area. They've worked hard, they've saved, they benefited from real estate in Arlington going up over the last 50 years. And they still come to me and they say, I don't know what I can afford to give away. And I say, well, go talk to the financial planner. And Todd will say that you can spend $200,000 a year in retirement and you'll still have money left over when you're 137 years old. And then they go, oh, okay, I can't afford to give something to charity to my family earlier. And sometimes, number one, you get to see the benefit of that, right? So it's as great as it is to leave something to family or to charity at death. It's wonderful to see people in your life benefit from that while you're still alive, and see your community benefit from that. So there's a lot of power to that. And then, to some extent, you have to hedge your bets, and you might want to have a charitable component upon your death. And so many people don't really like talking about death and mortality. I think as humans, that's just something in our nature it's very difficult to discuss. But I do this every day. And as we get into these conversations with people, it inevitably comes around to, what is your legacy going to be? My old college roommate I was on the phone with yesterday, he's from lives in Texas, he's a physician, and he was grappling with this. I haven't done anything significant in my life. What's my legacy? I said, well, you've impacted the lives of all these people that you've helped as a physician over the years. He said, that doesn't seem like enough. I said, well, you're a wonderful father and you're helping your son grow up to be, and so you start to think about how you're actually impacting your family and your community. And then you think about, how do I put the right documents in place to help everybody carry out my wishes and my intent, and to create that legacy. So I'm going to talk briefly about kind of the core estate planning documents, and then some other things that are complementary that we look at when we're doing the overall legacy and estate planning for people. The first and most important documents for every adult is the incapacity planning. So every adult, whether you're 18 or 85, should have an advanced medical directive and medical power of attorney document, so that if you become incapacitated and you're unable to make your own medical decisions, that you can pick who's going to be in charge of that for you. And in some cases, there's default rules that might be close to what you want, but you can be a lot more intentional by writing a document. The other thing that's very important about that is saying, what do you want to have happen at the end of your life? We're all going to die at some point. And if you can specify what you want to have happen, if you are suffering from a terminal condition, then your family can carry out those wishes for you, that your friends can carry out those wishes for you, and make sure that what happens is what you would wanted to have happen at that point. And then just as important is the general financial power of attorney. And this is really crucial to have it written the right way. It has to be a durable power of attorney, which means that it continues to work even if you are incapacitated. And you want a general power of attorney, something that's very broad and that allows someone to do basically anything you could do legally or financially if you were incapacitated. Whoever you pick to do this has a fiduciary duty. They have to act in your best interests, setting aside their own interests. But you want to pick somebody that you trust to deal with your finances to do that. And there's professionals that can do this if you don't have a friend or family member that you want to burden with that, or that you trust to do that for you. But by putting that document in place, we can then allow someone to step in and take care of you so that we do not have to go through a court guardianship or conservatorship process. And a lot of the financial power of attorney is using your money to take care of you, but you can optionally include the powers of giving so that your agent can continue to make gifts to family members or charities, even if you are alive and incapacitated. So to give you a couple of examples, my grandmother on my mother's side, she had been giving $1,000 to each of the grandkids each year that they were in college because education was very important to her. And she became incapacitated at age 91. And my uncle, as her agent, stepped in and he continued to make those $1,000 gifts each year because he knew that's what grandma would have wanted. And he could continue on that legacy for her. I have other clients that they make a regular pledge to their church or synagogue, and they want someone to be able to step in and do that for them, even if they're incapacitated, because that's such an important part of their life and their charitable giving. And so it's really important to have the right language in that, and your typical form off the internet's not going to capture that. So we have a very important discussion about what the scope should be, who should be in charge, and how can we continue to carry out your legacy even if you're incapacitated. Then the follow-up question is, how do we transfer assets upon death? A last will and testament, or will specify who's going to be in charge of dealing with your estate. That's your executor. It'll specify beneficiaries, who's going to receive assets. And if you have young children, like I do, who are under the age of 18, you need to specify who would be a guardian for those children if their parents were deceased. So all very important to put that in place. And then you can optionally create a trust during your lifetime or as part of your will, which can give you the ability to control assets after your death, and can give you additional benefits of potentially avoiding the court probate process as assets are transferred. And we can do some better tax planning as well. There's lots of different kinds of charitable trusts where you can create a trust that has a partial interest for charity and a partial interest for family members. Like, I want income to be paid to my son for 20 years, and then the remainder goes to charity. Or you can have trusts that are just to protect for a young beneficiary or a beneficiary with a disability. And so very important to set those structures up, because again, the default rules that are there don't always carry out what your wishes are. If we can go to the next slide, please. So then there's some other things that are very important and complementary to the actual legal documents. The first is title on assets. And a lot of people don't realize that the title on their assets can supersede what's happening in their estate planning documents. So if my wife and I own a house together with a right of survivorship, if one of us dies, the other one continues to own that property, because that's built into the title. Nothing had to happen to make that change. That succession plan is already there. Sometimes this can be very useful, but sometimes it can backfire. So it's important to understand what you've set up and how to do that. In Virginia, as in many other states, there's also a special kind of title for a married couple called tenants by the entireties that creates both that succession plan and also creditor protection from separate creditors. So if one spouse has a car accident or gets a lawsuit or bankruptcy, the asset can be protected for both spouses with that special joint title. So setting that up intentionally can make a big difference, and tying that in with the financial plan and the estate plan is very important. Likewise, beneficiary designations can supersede what happens in the estate planning documents. And back to our discussion earlier of what assets do you give to charity upon death, using those beneficiary designations can be very important. If I have a retirement account, I want to use the beneficiary designation to give a portion of my retirement account directly to my charitable beneficiaries outside of my estate and outside of the trust, so that that can go completely tax-free. If your retirement account goes into your estate or your trust, and then your estate or trust says, let's give some money to charity, the estate or trust will have to pay the income tax and give the remainder to the charity. So you can give a lot more money and much more powerful giving by using the beneficiary designations outside of the estate plan. And then the donor advised fund is just a wonderful charitable vehicle that I've used for many clients. And this is where I've really enjoyed partnering with the Community Foundation. it is like a charitable savings account effectively. And you can use it during your lifetime. You can put assets in during your lifetime and then tell the charities or tell the community foundation to make gifts to your specified charities during your life. But you can also add to this at death. So you can have a portion or all of your retirement accounts go to a donor advised fund or additional assets. It doesn't just have to be retirement accounts, but it's very helpful to have one place to collect things. I had one client I worked with for a couple of years, and the community foundation was very instrumental in helping her come up with an overall plan for her charitable giving, because she had many different charities she wanted to support, and she wanted some flexibility to potentially modify those charities and her wishes later on in life without having to update the estate plan. So we could connect to retirement accounts and her trust to the donor advised fund. And then the donor advised fund can do the work of giving out everything to charity. And if she decides that she changes her wishes on that, very easy to go back to the community foundation and work on that. And that's where the legacy planning that the community foundation does is just invaluable, to have those discussions and to have a vehicle to carry out that charitable intent long term.
Well,
so all very important things to put together.
Well, thank you, Ryan. That's what we're here for, to have those conversations about charitable priorities. When people come with, 30 charities that they're supporting, and they're trying to contemplate, how to be a little more strategic and how to affect, the impact that they want to make. We're there to have that conversation and to make those revisions over time to the legacy plan, so that they don't have to go back and revisit the estate planning document to do that. So we have our a financial plan, a budget in place, the estate planning documents and tools. But I'd like to turn to Christine now for what do we need to be doing day to day, month to month, year to year. Help us understand the regular maintenance tasks that we need to be doing, or that we need to be hiring someone to help us do.
Absolutely. And we've discussed a number of these on a higher level, but down on the daily, in the weeds, every day, every month, it's really important that you have some type of system set up for your expense tracking. Some people prefer to have it as a filing system. Some people prefer online, but it's really important that you have some type of system for expense tracking. It's also really important that you have daily bank account alerts. So no matter, you can set up the amount and you can have it come to your cell phone, or if people aren't comfortable with that, you can have an email sent to yourself with whenever something is spent, you get a notification so that you can follow up on that and make sure that there's no fraud. Unfortunately, with accounts, oftentimes I'll start with small amounts. I've seen several times, as small as $1, and people just let it go. And then the next thing you know, they're pulling more money, and they're out thousands of dollars that they can't get back. So it's really important that you understand and get those alerts. And as we had mentioned earlier, create if you don't have one, but definitely review your budget as you're going through things in life. As we all know, everything ebbs and flows. So it's really important to go over that and review it on a regular basis. Go over your monthly statements, all of them. Make sure that what's going out is actually what should be going out and that it's correct. Taxes, get everything organized in a file if that's the best way for you. Make sure you do your payments, etc. Passwords, I'm going to skip down to this one because this is really important. So many people let this go. So many people do the same password with maybe the letter B if they have Bank of America at the end of their standard password, and just leave it at that and then don't change it. It's so important to change your passwords regularly. They're better off to be long and with symbols in them. Maybe a sentence should be your password. Maybe a different sentence. I can't stand this bank with dollar signs in there, or whatever it may be. Something in there that makes sense to you, but change them regularly so that people can't get in. If you can, set up dual authentication. I know it's a hassle to have an email come to you or a text message come on your phone. It's just another wall that somebody cannot get through, and it's another protection for you as far as moving forward. So I would highly recommend that. And as Ryan was talking about the estate documents and Todd with the financial documents, it's so important to work together with all of this. Oftentimes I come across people predominantly in seniors, will they say, oh, I'm going to give that to my niece, Sherry. Well, have you at least written on the back of the expensive photo that this goes to Sherry? Does your estate planner know that should be in your documentation? How much is that piece of artwork worth? Somebody had a little 5x7 photo the other day, and I saw it online in a New England paper. The little photo was worth $30,000
Oh my
sitting in the
goodness.
sunshine. So I asked if we could turn it around. And when was the last time you've had your artwork appraised? Oh, it was just a few years ago. Wonderful. Do you know where that documentation is? Oh, sure, I can get that for you. And she showed me where the documentation was. It was from 1983. So that's just a couple of years ago. So a number of these things are probably worth a lot more. And a lot of people have furniture or certain items that should be part of their plan as well. You know, they may want to donate it. They may want it to be, you know, given to somebody else. Who knows? But until they express this, and they don't necessarily think that it's something they should go over, but it is very, very important. Otherwise, it just gets lost. It could be given away for $10 at a secondhand store or something. And last but not least, I would recommend checking your credit score at least once a year. Run your report. There's 3 reports you can run. Check it, see if anything is off. And if it is, contact the agency and get it cleared up. Rarely have I seen that, but it does happen. So it's really important to check this and make sure that everything is above board.
Absolutely. Well, this is a great checklist, and I do want to make a note for everyone attending the webinar that we do have some. We'll gladly share the slides after the webinar, and we have a couple of checklists that we can share with you. And Todd, you have a particularly good one that you have used that kind of maps tasks out month by month, particularly with the lens on some of the financial investment oversight pieces. Could you speak to that?
Sure. This is something that I actually send out on a regular basis through social media, rather than a 12-point checklist, because they come out on a monthly basis. But it's simply a rotating list of maintenance items that we should do regularly. And Christine's list actually has quite a few of these on here. Checking your credit reports and those types of things. But it's simple as when we get to a new calendar year, check your 401k contribution rate and make sure that it's still the right rate given the new IRS limits that likely went into force that year. Get prepared for tax season. February is the time when we start to receive those 1099s and other financial documents. So start to gather those as they come in and get ready, so you can be organized and on the front end of the tax professional's calendar instead of on extension back in October. And then March is kind of building that giving plan that we talked about earlier, and really start early to think about how do I want my charitable giving to happen and plan out through the year. Make your IRA contributions. Ryan should appreciate this one. Pull out your will, dust it off, read it, make sure that it still reflects your wishes. Is the guardian I picked 8 years ago the one that I want today? All those types of things. Check your credit report. And this is one I wanted to piggyback on something Christine said, and that is review and update your estate information document. And, you know, in terms of where is all this stuff? I have a checklist. I'm happy to share it with folks if they'd like it, of what should be on this estate information document. And mine for my family is a 1-page document. It has a list of all my accounts, my insurance policies, where my will is. Do I have a safety deposit box? Who's the executor of my estate? Who's the trustee of my trust? You know, it's a roadmap for the person who takes over the estate, that they don't have to go scrambling and looking in the mail for stuff walking in by the post office. They can actually have a roadmap that says, okay, start with Ryan, go get a copy of the will, go, you know, to this, my 401k is at this employer, I need to go look there. So it's a roadmap and an inventory. pull out your insurance policies, do your, keep going. There's a ton of these things that, we really maintenance items that should be happening on a regular basis.
Absolutely. Well, we've reached the time in our program where we'd like to open up the floor for questions. And I see that we've already had some good activity, questions asked and answered already through the Q&A. And let's see, we have one on how do you decide whether it's best to have a will or a trust? That one was out for Ryan. Do you want to speak a little bit about that, Ryan?
Sure, happy to answer the question for Cheryl. So it really depends upon the assets you have and the beneficiaries that you have. In most cases, a trust will end up paying for itself because it will allow you to avoid the court probate process. But you can also potentially avoid probate by having just a beneficiary on every asset. So in Virginia specifically, there's two sets of rules for probate. If you have less than $50,000 of assets that are left after everything with a joint title, a beneficiary designation, or that's already in a trust has been transferred. So if you have less than $50,000 of probate assets, there's a small estate rule that's pretty simple. If you have $50,000 or more of probate assets, then you have to go through the full 1 to 2 year probate process. So a lot of times a trust will end up paying dividends just to simplify that and reduce the additional costs of complying with all the court obligations that you have to deal with when going through probate. But it depends on the client. And I always talk with people about their options and help them understand what makes sense. Some of my clients say, I don't want to deal with setting up a trust now, and it's all going to go to charity anyway. I don't care. We'll just pick a lawyer to do the executor work. And even if it takes them 2 years, that's fine. But most people would still like the efficiencies of a trust. So, and there's lots of different ways to write a trust. You can have a trust that has onerous rules for the next 4 generations of how the money is spent and managed. And only if you show up every year on my birthday and put a rose on my grave, do you get an extra $1. Or you can have something very simple that says, let's collect everything and after my death, transfer it. And maybe if my kids are young, hold on to it till they're a little bit older. So you don't have to go crazy with it, but just avoiding the court probate process and the expense of that can make a big difference.
Absolutely. Well, Ryan, we have another one that's come through in the Q&A for you, and it's a long one, so I'm gonna read it to you. It says, do you feel like TOD and POD designations are underutilized for non-qualified investment and bank accounts? When might we not want to suggest using these designations? Do you suggest clients present their POAs to the various institutions for their approval or acceptance? Seems many institutions consider a POA outdated after a period of time, or for one reason or another will not honor the POA.
Okay, let me go through each of those one at a time, and I've got it here on the screen too.
And there's one more at the end, and we can talk about that one too. And I bet Todd has something to say about the QCDs.
Yeah,
well.
I'll leave that one for Todd. So let me start with some of these other title questions here. So TOD is transfer on death. POD would be pay on death. Two ways of saying the same thing. It's basically saying, when I die, I want the financial institution to give this asset to this beneficiary or this set of beneficiaries. And those are what we call non-probate transfers. You've already set up that succession plan. And as long as the beneficiary is still there when you have died, either that it's an institution like the community foundation that still exists, or it's an individual who has survived you or outlived you, then they can make that transfer. The financial institution can make the transfer automatically without having to go through any court process. And so certainly you can do this for your retirement and life insurance. Those are the things people think of because you go enroll for your retirement account and they say who are your beneficiaries, and the same thing with life insurance. They ask you about beneficiaries. But you can do this on investment accounts, bank accounts as well. And so sometimes this can be a valuable tool. And again, it's not something you can really look at in isolation. You got to look at the overall goals that the client's trying to accomplish. But to give you an example, we talked earlier about the special joint title for spouses, tenants by the entirities, that provides protection from separate creditors. So if one spouse gets sued, you can protect the entire asset for both spouses. A lot of times I'll tell my clients, even if they've created a trust to transfer assets upon their death with the rules and protections that they want for their future beneficiaries, they'll keep their investment account titled as the two spouses as tenants by the entireties, so that they have that creditor protection during their lifetime, even as they're adding and subtracting assets. And then they set up that asset to pay on death to their trust. Another example would be for real estate in Virginia or DC. You can write a revocable transfer on death real estate deed. And it's the same idea. You say in the land records, on my death, I want to transfer this property to, and you can name any kind of beneficiary, a trust, an individual, a foundation. And it's revocable. So you can change it during your lifetime, very flexible. If you have a trust and you want to put your primary residence in the trust, there's a rule that allows you to do that without affecting your mortgage. But let's say you had a rental property. You might not be able to put your rental property into your trust during your lifetime without affecting the mortgage, but you can leave it in your own name and set it to transfer on death to your trust or to your chosen beneficiary. So all very valuable tools, and it just kind of have to look at the overall puzzle of what we're trying to accomplish. And then sometimes that makes sense. To the question about power of attorneys or POAs, again, your power of attorney allows somebody to act on your behalf, either if you're incapacitated, or you can just make one out of convenience. I'm tired of managing my finances at the age of 95. I'll let my child or grandchild or attorney do that for me, right? So if you have a power of attorney, it's good to take it to the financial institution in advance, because sometimes it'll take them a while to approve it. They have, under Virginia law, 7 days to look at the thing. And then at the end of the 7th day, I'm the lawyer calling up saying, why haven't you looked at this yet? It really depends on the financial institution. If you go to a community bank like John Marshall Bank here in town, they'll look at it that afternoon and approve it. If you go to Bank of America, it goes off to Charlotte, North Carolina somewhere, and good luck, right? And this is, again, where a trust can be very valuable. It's easier to have a trustee managing assets for you if you're incapacitated, using a trust document, than it is to use a power of attorney in a lot of cases, because the trust kind of gets pre-approved when the trust is set up and the assets are put in there. But one last example before I turn it over to Todd about the power of attorney. You see a lot of people will set up a joint bank account with an elderly parent, for example, right? I'm helping take care of mom and I'm helping her with all of her bills. So I've got this joint bank account. It's me and my sister and my brother and my mom are all on the account together, right? It seems like a great idea. But then if any of the kids get sued or have a creditor coming after them, mom's money is gone. So what you really want to do in that situation is either create a trust and put the kids on as trustees, or set it up as mom's account with one or more of the children as agents under a power of attorney. So it's not their money, they're just acting on behalf of mom. And then mom can set up a pay on death beneficiary designation to say where it goes. So putting these pieces together in the right order makes a big difference. And if you don't understand what you're getting into, you can create a bigger problem than you're trying to solve. So let's have Todd talk about the QCDs though.
And I'm going to piggyback one quick item on the POAs from an advisor's perspective who deals with getting them inserted on accounts at a financial firm. What Ryan said earlier about being durable and general is hugely important. Older POAs have limitations. They can or cannot exclude retirement accounts and all these little twists and turns. That's where financial firms go crazy. Give me something that's more recent, durable, general, and we're all over it. So one of the financial tasks that we talked about in the question about QCD. So let's first define a QCD. It's called a qualified charitable distribution. When you are old enough, by the IRS's definition, to make what are called RMDs, required minimum distributions, out of your IRA, and let's back up a quick step and define that real quickly. When you put money into an IRA, whether you did it through a 401k that was rolled over or you did it directly into the IRA, you made a deal with the government. You said, don't tax me now, tax me later. Well, government says there's got to be a later. That's RMD age at age currently 72. So come 72, you got to start taking money out. It's not a penalty. It's just the back end of the deal you made 30 years ago. So you got to take a certain amount out. That money is taxable to you. However, there's a provision that says every individual can give up to $100,000 out of their IRA, and if it's directed directly to a charitable organization, 501 standard 501c3 type organization, that portion, it counts towards your RMD requirement and it is not taxable. So this is a really important part of tax and charitable planning for folks that are at RMD age. There's some nuances in there about how, whether it's better to give appreciated stock or give this, and a lot of stuff about itemizing and whether or not you're at that level or not. But just knowing that QCDs are out there and exist becomes a really important conversation for you with your tax person and with your financial advisor to see how it works for you. I had a great example of this just recently. I have a number of folks, I have a ton of folks that do qualified charitable distributions. And we have, they have 3 or 4 specific they wanted to give to the college, they wanted to give to the church. And then they had the rest of their RMD. They don't need the money. They've got 3 pensions, government, military, et cetera. And they did Social Security, so they didn't need the cash. So what do we do if that? We've got to take the money out. So guess what? They can gift it to the community foundation. Now, there's some nuances. You can't put it directly into your own donor advised fund. The IRS wants it to come out and not be extended out for a period of time. That's the point of the donor advised fund. But you can give it to a special interest fund or other mechanism through the community foundation, and that's what they did. So it's a great example of the combination of a QCD and your community foundation to really make your charitable giving both effective, manageable, and organized.
The QCD is a great tool. And
Huge.
I think when we were having a conversation in preparation for this webinar, we talked about the penalty for not taking the RMD. You want to share that real quick?
Yeah, it's severe. This is one of the biggest, most severe penalties the IRS can levy. So if you are required to take out $100, just to make the math easy for everybody, if you're required to take out $100 and you fail to do that, the penalty is $50. It's 50% of the amount that you did not take out that you should have. So if you've got the option of taking it out and giving it to a charity, or taking it out, not taking it out and giving it to the IRS, seems pretty clear. You should get that money out. So again, one of the things that Christine and I both do for our clients are make sure that people hit these deadlines, right? It's 12/31 is a big date for RMDs. You've got to have them done by December 31st. And just as an anecdote, we've had a lot of issues with QCDs because of the mechanics of how they are done. Just because they have to be done in cash. They're on printed checks that have to get mailed to the respective recipient. Unfortunately, our lovely post office has created variables in this process that are out of my control, Christine's control, Christy's control, et cetera. So I just put a note out to my clients literally last week that said, I am moving up my recommended completion date for all QCDs back to September 1. We've had examples where the post office never delivered the check, and that gets into missing the RMD, 50% penalty. You got to give time for variables like this in these processes.
And whenever I mail things for clients, or even talking with family or friends about it, even before we had this craziness with the post office, recommend sending everything certified. It's like $4. It's so worth it. You know, it gets there, you know, it's safe and secure. It's a little bit of a hassle, but if you do it early, it's not. You get there, and I do that for many people, go in and mail it. And that's also why I think it's so important to have all of this planning team together. A lot of people think if they have one piece or a couple pieces of the puzzle, they're good. I'm good to go. And don't realize all these other little pockets that can fall through when their best intentions are to leave things a certain way, and they don't check those boxes, cross the T's and dot the I's, and it's so easy to let it slip. So I'm so glad that you pulled this together.
And to
Well-
piggyback on that, Christine, sorry to cut you off, Christy.
Oh, go ahead.
It's having the professional team together can provide a really good return on that investment, right? People will say, oh, why would I need to pay a professional to do this? I can figure it out.
Mhm.
But having somebody who asks you the right questions, because you might not know what you don't know,
Right.
and having people that can help follow through on all this to make sure it's done right the first time, on time, without the penalty. We can reduce the taxes and administrative costs. Usually the work that I do, and I would imagine that Christine and Todd do, pays for itself multiple times over. So it's really a good leverage to have a team, let alone just the peace of mind of not having to
Absolutely.
the first person responsible for all of that. Yeah.
And in building a team that is collaborative in nature. And, I know from working with each of you that you work with other advisors, in a very collaborative fashion, sharing information, working together to do what's best for the client. Now, we do have another question in the Q&A. I guess this one goes out to you, Ryan. How dangerous is an old will? My children are now adults, but the will has one kid as a minor.
I mean, it might be fine, but I can't tell you without reading it and talking about your current circumstances. So the will might very well still work and get to the right place, but it's worth doing a checkup, right? Again, the rules could have changed, or the tax law could have changed, or something in your family life could have changed. And it's not that the old will won't work necessarily, but that by doing something new or additional, you can get a better outcome that wasn't available. To give you an example, the estate tax changed dramatically in 2012 with something called portability. So if you look at estate plans that people did before then, I had a lot of couples that they went and they did the estate plan, and there was a trust for each spouse. And then when one spouse died, the first trust splits into two trusts, a marital trust and a family trust. So now you have three trusts to deal with, and it gets more complicated from there. That made sense at the time, but now with the simpler tax rules, in a lot of cases, we can avoid that. And so we can actually improve upon the plan. So I would just say it's worth a checkup, because you don't know what's changed. And then that's assuming that the will was done correctly back then and so forth. If you had an attorney help you, probably that's the case. But I had a client who brought in the will recently, and it had the right witnesses on it, and it was signed by him, but it didn't have something called a self-proving affidavit, which is a notary sworn statement that says, I was here and we saw everybody sign it properly. So you still have a valid will, but if you show up at court, you then have to go find these witnesses from 20 or 30 years ago to attest that they were actually there and they saw you sign it. And if it was a year ago, that might not be too hard, but if it was 20 or 30 years ago, good luck. And we hope those people are still around. So sometimes updating things is worthwhile just for the peace of mind, let alone taking into account things that have changed or efficiencies that are now available.
Well, we are coming up on the hour, and I guess I don't see any additional questions in the Q&A. I just want to thank our panelists so much for joining us today, for sharing their expertise, and thank you to all who have attended the webinar today. We hope you've learned some strategies to keep your financial affairs running smoothly. And as you continue to build your financial confidence, we hope you will see the power and potential of your well-managed financial resources. These resources can help you realize all of your goals, including your charitable ones. Please reach out to us at the Community Foundation if you would like to talk about how to make charitable giving a part of your financial and estate planning. We can help you maximize the impact to the organizations that you care about. And of course, we will send you the contact information for all three of our expert panelists. We all welcome any follow-up questions that you might have. And we thank you again for being with us, and we hope you have a fantastic day. Thank you.
Thank you.
Thank you.
Thanks, everybody.